Closing costs are a part of every real estate transaction. In this video, I'm going to explain all of them for you. And stick around to the end because I'm going to show you 4 ways that you can save on closing costs for your next real estate transaction. Welcome back, guys. My name's Nick. I'm in Nashville, and I am here to help you learn everything you can about real estate and the neighborhoods in Nashville. If you need help moving, feel free to reach out to me, send me a DM, comment below, or if you're really brave, text me. So what are closing costs? Closing costs are a part of any real estate transaction. Generally, you're going to estimate about 2 to 3% of the loan amount. And in today's example, we're going to use a $222,000 purchase price home that was using an FHA loan. Now, FHA loans typically have the most closing costs, so we're going to just give you that right off the bat. FHA is a type of loan that's used by first-time home buyers that allows you to get into a house for 3.5% down instead of a conventional 20% down loan. It's a great option for you if you don't have enough money for the down payment. Now, all these costs when you do your real estate transaction are going to be listed in what's called a closing disclosure. The closing disclosure by law has to be given to you 3 days before closing. Now, the reason we do that is because by law, the lender has to show you and break down every single cost that is associated with that transaction. And you need to make sure that the one you get 3 days before is exactly the same or very similar to the one that you're getting when you're signing the docs at closing. So we're going to break the closing costs down into 4 categories: loan fees, title fees, taxes, and prepaids and escrow. Now, when you apply for a loan, the lender's got to get paid. They're going to charge you a certain amount of costs associated with that loan. The first one's going to be origination, which we can generally estimate to be about 1% of the total loan value. This is what you're paying the lender to get all your documents together, basically to do all the work for you. There's also a doc review fee that came in at $315, a processing fee of around $300, an underwriting fee of $375, which is what the lender charges for when they go through your credit, they go through your bank accounts, they make sure and verify that you're qualified for the loan. Appraisal fee is generally between $500 and $600. Now, an appraisal is necessary because what that does is a certified licensed appraiser goes out to your neighborhood and compares your house to all the other houses on the market that have recently sold to determine its value. Now, if its value is accurate, everything's good with the loan. Say your appraisal comes in under what the sellers are asking for their property. Well, at that point, you have 2 choices. You can either back out or you can negotiate the price down. A flood certification of $15. This just certifies that you either are in or are not in a flood zone. If you are in a flood zone, that could incur an additional insurance charge of flood insurance. And the last one is the mortgage insurance, or the PMI. And this is typically only with FHA loans. So what this is because you're entering into the loan without 20% down, they want to make sure and insure that loan to make sure that they're going to get their money out of it. So they're going to charge you an extra amount per month called your PMI until you get to the 20% down. Now, the cool thing about this is that when you have 20% equity in your property, you can refinance your loan, and this completely goes away and you don't have to pay it anymore. So our next category is title fees. Now, what is title? Title is a verification of ownership. The person that's selling it to you has legal title to that property. They are transferring the title to you, and the title company handles that transaction. Now, title is important not only to you, but also to your lender, because say you stop paying your mortgage payments and that lender has to foreclose on your property. They also have interest that that title is free and clear and that ownership is 100% transferred. Now, how can title get messed up? Here's a situation that could happen. Say there was a house and the owner died and had 5 kids. One of them was unknown. So 4 of them were on title. The other one was living in Timbuktu and nobody knew about him, but all of a sudden they come back on the scene. Now they have vested interest in that property. Well, they've already sold the house to you, so technically that new owner could have a claim on your title. It's a very rare situation, but it could happen. And so to mitigate that, we have what's called title insurance. Title insurance for the lender was $540. That means you're paying for the lender's title insurance policy. Letter fee is $35, which is writing up of the actual contract. The settlement fee is the $595. That's what the title company charges to do all this work for you. And the exam fee is $200. Exam fee is also an attorney fee. That's where a legal attorney looks over the document, ensuring that everything is legally binding and correct. The next category is taxes. Yep, there's no escaping it. Now this normally is based on a percentage, and depending on where you live, taxes can be different in your area. For this transaction specifically, there was a recording fee of $95, a transfer tax of $232, transferring taxes and ownership from one party to the other, and a state tax of $644. The final category is what's called prepaids and escrows. So escrow is like an imaginary bank account that holds money specifically for your house. Taxes and homeowners insurance are combined with your primary mortgage payment every single month. That money is paid upfront and put into an escrow account, so you don't pay it directly every month. In this case, the homeowner's insurance was $1,300, prepaid interest of $194. Now that is, when you get a loan, you're not going to pay your first month. So you're actually going to pay your first mortgage payment 2 months after you close on your house. But the bank that owns your loan is still going to get paid interest. So they want that interest upfront for that first month that you're not paying your mortgage payment. Your HOA fee, in case you live in an HOA neighborhood, in this case, to get into the HOA for the first time is $250. You don't have a choice with that. And the last one is the owner's title fee, which was around $525. Now, before you paid the lender's title fee, now you're paying your own title fee, because remember, both parties need to be protected when it comes to title. Now you can shop around for some of these costs to include title insurance, but a lot of times most people don't because the savings are not substantial. Generally, there's not a lot of variation and fluctuation. So I know that's a lot. All right, don't be scared though, because I'm going to show you how we can reduce that cost. So in this case, the total closing cost was $13,525 roughly. That means on top of your 3.5% to get into the loan, you're going to have to come with that $13,000. Now, the majority of people will actually roll these costs into the loan. Some lenders will let you do that, other ones won't. But here's 4 ways to save. Step number 1. We have what's called a seller credit. A seller credit is where the seller gives you, let's say, $10,000 as a part of the negotiation for the deal that your good realtor was able to negotiate for you, that you can use towards your closing costs. So then you only have to come to closing with the $3,000 instead of the $13,000. The next tip is to get quotes from 3 different lenders. Generally, if you work with a realtor, they already have a team in place for you that they know, like, and trust, that's going to be seamless and easy. But if you really want to save, I suggest getting quotes from 3 different lenders, one of them being a credit union, because credit unions typically have cheaper closing costs than a lot of the private lending companies. Number 3, we have what's called down payment assistance programs for FHA. There are 2 to 3 different down payment assistance programs where if you apply for them, they will give you money to help with either your down payment, or that money can be used to pay for some of your closing costs. So we've actually had people only come out of pocket like $1,000 just to get into a house because their whole down payment was paid for. And the 4th way is a lot of lenders will allow you to use what's called gift funds towards your closing costs. A gift fund is a fund that someone gives you, whether it be a birthday or you guys just got married and you have money that you didn't make through your W-2 or through your business. These funds can be used toward your closing costs. That's all I got for today, guys. I hope you enjoyed the video. If you have questions, DM me, send me a comment, follow me on Instagram, or if you're brave, send me a text. Oh, and if you want to learn 20 more tips about buying your first home, click here. My name's Nick. I'm in Nashville. Would love to help you. Have a wonderful day.